Parking lots across America are filling with silent fleets of white vans and silver sedans, all wearing the same green and white logo, Enterprise. Cars that once moved families, workers, and tourists now sit motionless, their windshields coated in dust, their tires slowly sinking into the pavement. According to internal industry trackers, Enterprise's used car inventory has ballooned by more than 45% since late 2023, and that's just what's visible. Beneath the surface, one of America's biggest private companies, once a symbol of endless mobility, is quietly collapsing under the weight of debt, oversupply, and an industry turned upside down. The question isn't whether Enterprise will survive. It's what happens to the rest of the car market if it doesn't. Because what's happening inside Enterprise today could decide the future of car rentals, used prices, and even how Americans travel tomorrow. For decades, Enterprise Rent-A-Car was bulletproof. The family-owned empire controlled nearly 40% of the U.S. rental market, buying more than 1 million vehicles a year from automakers like GM, Toyota, and Ford. They were the car industry's secret weapon, a guaranteed buyer that kept factories running even in slow years. But when the pandemic flipped everything, Enterprise's greatest strength became its curse. In 2020, they sold off hundreds of thousands of vehicles to survive the travel shutdown. Then, when demand exploded again in 2021 and 2022, they overcorrected, flooding their fleet with overpriced vehicles at the peak of the market. According to Bloomberg, Enterprise spent billions replenishing its cars at record high prices, often paying $10,000 to $15,000 more per vehicle than pre-pandemic levels. And now, those cars are losing value faster than any time in modern history. Here's the problem. Enterprise doesn't just rent cars, it owns them, meaning every drop in used car prices directly hits their balance sheet. A report from Cox Automotive shows that wholesale used prices have fallen nearly 18% since early 2023. That's catastrophic for a company that holds over 1 million depreciating assets. Every month, the value of Enterprise's fleet is evaporating, billions in paper losses piling up like a slow-motion implosion. And that's not even the worst part, because as car values drop, financing costs are exploding. Interest rates that hovered near zero in 2020 now sit above 8% for corporate lending. Enterprise, which once borrowed cheaply to expand, now faces one of the tightest credit markets in decades. The same lenders that fueled its growth are suddenly tightening their terms, or walking away completely. But here's the part most people don't realize. Enterprise isn't just one company. It's a sprawling ecosystem. Enterprise, Alamo, National, and a massive used car resale division called Enterprise Car Sales. That last one was once a hidden goldmine. Enterprise would rent cars for about a year, then sell them directly to consumers at high margins. It was genius, a constant cycle of cash flow. But that model only works when used car prices are stable or rising. Today, it's the opposite. Dealers nationwide are slashing prices to move inventory. Carvana, Hertz, and even traditional dealers are all undercutting each other to survive the slump. The market is flooded, buyers are cautious, and Enterprise's once profitable resale channel has turned into a bleeding wound. According to a J.D. Power analysis, used rental returns are now selling for as much as 25% below 2022 levels. Multiply that across hundreds of thousands of vehicles, and you start to understand the scale of the disaster. So what's causing this collapse? It's not just Enterprise's missteps. It's the entire system cracking at once. Start with the supply side. Automakers overproduced again after misreading post-pandemic demand. At the same time, consumers are pulling back hard. Average monthly payments for new cars just hit $750, the highest in history. Meanwhile, subprime auto delinquencies have surged to their highest rate since 2009, according to the Federal Reserve Bank of New York. That means millions of Americans are defaulting on their car loans, flooding the market with repossessed vehicles. All of that inventory pushes prices down even further, creating a chain reaction that hits enterprise squarely in the gut. Every repo, every price drop, every unsold car, it all ripples back into their fleet valuation. And yet, enterprise can't just stop buying cars. Their entire business depends on availability. If a customer lands at an airport and can't find a rental, that's a brand hit. So they keep replenishing, trying to balance an impossible equation of supply, demand, and collapsing resale values. According to insiders quoted by Automotive News, Enterprise has started quietly delaying new fleet purchases, cutting back orders from major automakers by as much as 20%. For GM and Stellantis, that's terrifying, because Enterprise isn't just a customer, it's a lifeline. When retail demand slows, automakers rely on rental fleets to soak up excess production. If Enterprise starts retreating, the ripple effect could trigger layoffs, plant slowdowns, and yet another hit to America's already fragile auto sector. But there's a darker layer to this story, one that involves Wall Street. In recent years, Enterprise and its competitors began securitizing portions of their fleets. Essentially, they bundled vehicles into asset-backed securities, the same kind of financial instruments that helped trigger the 2008 housing crash. Investors bought in, expecting stable returns from rental payments and used car sales. But now, those securities are under stress. If the value of the underlying cars keeps dropping, the bonds themselves could lose value, forcing lenders to demand more collateral. It's a ticking time bomb hidden inside an industry that most Americans think of as harmless. The next time you rent a car at an airport counter, remember, that vehicle might be worth far less than the company needs it to be. The perfect storm is here. Rising costs, falling values, shrinking demand. Enterprise is private, meaning it doesn't disclose its finances like Hertz or Avis. There's no stock price to warn the public, no quarterly earnings to dissect. When Hertz went bankrupt in 2020, everyone saw it coming. With Enterprise, we won't. Not until it's too late, but signs are already leaking out. Insider sources report layoffs in regional offices. Franchise operators quietly selling off older cars to raise cash. Employees describing massive slowdowns in new bookings. Every line item is up, except revenue. Travel rebounded, rental rates skyrocketed, and used cars sold for outrageous premiums. For a brief moment, they were printing money. But like many companies in the post-pandemic boom, they mistook a temporary spike for a new normal. They expanded fleets, raised prices, and bet that demand would never slow. Now, as the economy cools and the consumer cracks, that optimism has turned deadly. Inflation has eaten into travel budgets. Gas prices remain high. Insurance costs for rental companies have jumped nearly 25% since 2022, according to S&P Global. So where does this end? Maybe with a bailout. Remember, Enterprise employs over 80,000 people worldwide and operates one of the largest private fleets on the planet, nearly 2 million vehicles. A collapse wouldn't just rattle the car market. It would hit airports, insurers, automakers, and the entire travel ecosystem. Enterprise's contracts with governments and Fortune 500 companies make it systemically important in ways few realize. That's why some analysts quietly predict that, if the worst happens, Enterprise could become the next too big to fail story. The Hertz crisis on steroids. But there's also a scenario where Enterprise survives, leaner, smaller, and more ruthless. They're already testing new strategies, subscription services, electric vehicle rentals, even AI-driven fleet optimization. But each of those requires massive upfront investment. And right now, cash is tight. According to a Reuters investigation, Enterprise's average rental rates have fallen by nearly 15% year over year, a desperate attempt to attract customers back. Yet even with lower prices, consumer hesitation is growing. People are traveling less, staying local, and skipping extras like insurance and upgrades. The company's once predictable margins are disintegrating. Still, the story of Enterprise's collapse isn't just about one company. It's about how fragile the modern car economy has become. For decades, automakers, lenders, and rental giants formed a perfectly balanced triangle. Manufacturers built cars, fleets bought them, consumers rented or financed them. It worked until it didn't. Now every corner of that triangle is cracking. Manufacturers are cutting production. Lenders are raising rates. Consumers are walking away. And at the center of it all sits Enterprise, a quiet giant trying to hold the system together with duct tape and debt. If you want to know how deep this collapse really goes, hit subscribe, because what's happening with Enterprise is just the beginning. Hertz is already unloading cars at record speed. Avis is slashing its fleet. Dealers are panicking as used prices slide further. This isn't an isolated crisis, it's a chain reaction. One that could reshape the American car market for a generation. So, what happens next? Maybe Enterprise pulls off a miracle, selling just enough vehicles to stay afloat until rates drop. Or maybe they don't. Maybe we wake up one morning to headlines announcing one of America's largest private bankruptcies. Either way, the signs are there. The numbers, the layoffs, the silent lots filled with unsold cars. The collapse isn't coming, it's already begun. And the real question isn't whether Enterprise will survive. It's who will get caught holding the keys when it doesn't.